Rick, I'd like to focus our discussion today primarily on the topic of valuations. There are a lot of companies across a range of commodities that we follow, probably with the sole exception of uranium, that are cheaper today than they were a year or two ago. So I thought it would be interesting for us to go over your thought process in terms of ascribing valuations to some of these companies in capital-intensive businesses where earnings are cyclical and where the cost of capital or changes in the cost of capital can matter when you're valuing that project. Before we begin this discussion on valuations, I get one philosophical question in each of these calls, and I'm going to use it today to get your general thoughts on the markets and the economy. One of the things I am noticing in terms of a recently accelerating trend in mainstream media today is a lot more coverage on the topic of debt and deficits. At a 5% interest rate, it no longer seems like a faraway problem anymore. Now, the sustainability question with regards to the current debt and deficit levels and the longer term consequences are certainly an important part of this discussion. But the flip side, and I think it's important to acknowledge the flip side as well, is the fact that over the last 3 years, it is primarily because of those debt and deficits and their liquidity assumptions for the economy and the markets that the economy has remained afloat and asset prices have remained elevated, in some cases even in bubble territory. And this is all through a global pandemic and a 5% increase in rates. We seem to have replaced the word distorted with resilient to describe the economy and the effects of all of the liquidity on the economy. Now, as someone who has been talking about debt and deficits and the consequences of it for many years now, I was interested in your thoughts on this topic. When you look across the impact or the lack thereof on various parts of the equity and credit markets following what has been one of the most aggressive hiking cycles of the last 40 years. How do you reconcile this contradiction that on the one hand, we've been accelerating the process of borrowing from the future, but on the other hand, it is creating continued resilience in the face of a lot of adversity that we've seen over the past few years? Has anything changed in your views with regards to the efficacy of borrowing from the future to create Janet Yellen's world without recessions? And the second question, do you believe that the effects of monetary policy tightening are still ahead of us for the economy?
Respectively, no and yes, which is to say that my view of the efficacy of spending more than you earn is unchanged. My belief is that what we are seeing is a lag. I am impressed with the resilience of the U.S. economy, and I'm distressed by the fact that the government hasn't taken advantage of this resilience to temper their idiocy. I'm reminded of the quote, and I'm sorry I forget who the quote was, about how one goes broke, slowly at first and then very rapidly. My assumption is that the impact of higher interest rates will continue to be felt in the economy, although I must say that I'm surprised and delighted that the impacts have taken as long to manifest themselves as they have. I think that there is the same perception around the deterioration in the purchasing power of the dollar that exists in the early part of the decade of the 70s, which is to say the writing is on the wall, but because people haven't yet experienced too much of it, there isn't the fear that I think the statistics should be drawing forward. For one thing, and we've discussed recency bias, you and I, an awful lot, people's expectation of the future is set by their experience in the immediate past. People are very, very poor students of history. They extrapolate forwards poorly, and they extrapolate backwards poorly too. And the fact is that the last 40 years have been the best economic circumstance probably in human history. And the consequence of that is that people's experience in the recent past make them more aggressive and more tolerant of failure than I think they ought to be. One example would be the population's reliance on the consumer price index as an index showing the deterioration in the purchasing power of the US dollar, which it is not. The population, because their experience since 1982 has been that inflation isn't really a concern, is happy to look at the CPI and conflate that with an index that measures the deterioration of their purchasing power. I suspect that if individuals looked at their household budget the way I tried to last year, that for many people, the purchasing power of their savings is declining at 7% compounded. That becomes really problematic when you juxtapose the interest on the U.S. 10-year Treasury, 4.6 the last time I looked, with the deterioration of the purchasing power of savings, which is to say 7%. Has that perception spread to the citizenry? I don't think so. Has it spread to the investing class? It certainly is beginning to do that. Warnings from investors through a whole range of big picture, highly involved hedge fund and corporate leaders have indicated caution around the delayed impact of higher interest rates and around the structural instability with regards to the U.S. economy. That's a very long-winded answer, Aditya, but I repeat that the liquidity-driven strength in the U.S. economy is not reason to change one's view of the underlying difficulties in the U.S. economy. Perhaps too many of our public figures and too many people in the media conflate the terms liquidity with solvency. But remember, they're very, very, very different terms.
I want to return to a point you made about liquidity and solvency. Again, when I look at this from an investor point of view, and when I look at it from what is happening in the bond market right now, I do not see any disintermediation from the bond market, despite the tremendous drawdown that we've seen in bond prices. I was very interested in your views on this, particularly for someone who is starting a bank. I imagine you have a very strong view on this subject.
We haven't probably had disintermediation, as much disintermediation as we might otherwise expect in the bond market because of the incredible deterioration in the principal. In other words, there's much less capital to disintermediate. I personally, Aditya, wouldn't own long bonds on a bet. I believe that there's a chance that we're going to run into some economic headwinds. And as a consequence of that the Fed will take interest rates down, which will lead to some capital gains in bonds. I don't own bonds for capital gains. I own bonds as low risk shelters of capital. And I don't believe that the long bond is low risk. I'm one of those who actually believes that the purchasing power of my savings is declining at 7% compounded. And the idea that somebody proposes to pay me 4.6 in a currency that's depreciating by 7 sounds to me like astonishingly bad math. I have other concerns around the credit market that we might share as well. I don't believe that the softness in some commercial real estate markets, and hence in the mortgages, has found its way in the market. Nor do I believe that tightening of credit, particularly around non-investment grade credits, so-called junk credits, whether or not they're listed or over the counter, I don't think that those have been expressed in the credit markets yet either. I don't think the rollover of 5 to 7 year term loans to sub-investment grade credits, where there's a financing wall in the future that might not be able to be met, has expressed itself in the future. And in particular, Aditya, I'm really concerned about the high yield ETFs, the junk bond ETFs. where the top structure, the ETFs themselves, are very large, well over $1 trillion in that asset class, and extraordinarily liquid. But the ETFs own bonds, junk bonds, that are highly illiquid. If concerns about credit quality and credit availability begin to surface, which I believe they will in 2024 and 2025, and the holders of those high-yield bonds, high-yield ETFs, begin to be concerned about their principal and go to sell, that would be extremely problematic because the ETFs are highly liquid. But when redemption notices come in, the managers have to sell the underlying assets, which are illiquid, to handle demand for redemptions. And I'm not sure they're going to be able to. If I was looking on the horizon for the black swan in the credit markets that could resemble the black swan that we enjoyed, if that's the right phrase, or at least experienced in 2008, I would say that the thing that scares me the most are commercial real estate mortgages and junk debt. I was recently in Midtown Manhattan, and I had occasion to visit somebody who I'm trying to do some business with in a B-grade building in Midtown. And I was distressed to find that that building was 16% occupied. With 16% occupancy, the building can't fund operating expenses and property tax, let alone the mortgage. And I'm very, very concerned about the impact of this. I'm concerned about the impact in particular on the fortunes of those banks who regarded second-tier office buildings and regional and super regional shopping centers as a very important asset class. Banks that might have 60% of their assets involved in this with only a 7 or 8% equity slice. To the extent that 50 or 60% of a bank's portfolio experiences a 25 or 30% decline, that does a really, truly ugly thing to the equity of a bank where equity is 7% of total assets. And that does scare me, I have to say.
We've just been through a dress rehearsal of what liquidity and zero interest rates can do to the economy in a very adverse situation. Do you think we return to that?
It depends on the time frame that you express that statement in. There is such a reserve of talent and creativity and tenacity in the United States that my suspicion is that our individual efforts could probably fund our collective stupidity at least one more time. We were able in the tech crash, I'm going way, way, way back. We were able in 1987. We were able in 2008. We were able in 2000 to add liquidity to the system, to artificially lower interest rates, and to re-engender a sense of confidence. Partially, we were able to do that because we've been in a tremendously good market, going all the way back to the post-Volcker years in 1982. How many more times, and this is perhaps a rhetorical question, how many more times will we be able to hoodwink the citizenry that liquidity and solvency are the same thing? That takes me back to the quote. How does one go broke? Slowly at first, and then very rapidly.
Yep. Interesting. I want to come back to the commodities sector, Rick, which is the space that I spend all my time thinking about. I think one of the lessons I've learned from my investing career is the macro is unpredictable.
If there's anything, Aditya, that I hope you keep for the rest of your career and that the people who listen to this video take from them, It's the following. There are very few truisms in the world, but one truism is this. In commodity markets, if you have a commodity that is necessary for the maintenance of the material well-being of humankind, and that commodity comes to be priced at lower than the cost of production, either the commodity becomes unavailable, which has never happened in recorded history, or the price of that commodity goes up. Will it happen in a year or 2 years or 3 years? One never knows. What I try to do now is focus on absolute valuations. What that means is that I'm usually fairly early, and I run into the difficulty with regards to time value of money, which is to say, if you're 3 years early at a 7% discount, it's tempting to say that you're wrong as opposed to early. But I exist in commodities markets where the recoveries overshoot and valuations overshoot too. I think one of the questions around timing has to do with something that's very different than arithmetic. It has to do with fear of missing out. The investor whose money is, quote, trapped in an investment that hasn't performed yet doesn't do analysis solely based on that asset, but rather he or she compares themselves with somebody who invested in something that worked, either accidentally or not. Say one of the big tech stocks, as an example. Fear of missing out is something that I'm absolutely, positively not guilty of anymore. And I really, truly believe that some people's expression of time preference has nothing to do with discounted net present value, or even very little to do necessarily with the investment position that they took, but rather to do with the intermediate performance of that investment relative to some other investment class, which is in the news at that point in time.
This leads us well into the second part of this discussion, but before I switch to discussion where we are looking at the company level, I would be very interested in your thoughts on another high-level subject, which is the sentiment in the gold mining space right now. Despite the strong commodity prices, the sentiment measured in terms of fund flows and valuations in many segments of the equities are arguably disconnected from the macro environment. As someone who's been an investor in the space for many cycles, how do you process this disconnect in terms of informing your own investment thesis?
I think you have to look back at the decade of the 70s. In the early part of the decade of the 70s, the inflation warnings were on the wall. The debt and deficits around the simultaneous war on poverty and war in Vietnam were around us. Gold admittedly popped in the first part of that decade after having been price controlled for 40 years? In 1975, if my memory serves me well, the Fed went after inflation and raised interest rates, and the gold price fell by half. The perceptions of inflation weren't with us, but the impact of higher interest rates were, and the consequence of that is that the dollar strengthened, the bond market got clobbered, and the gold price and gold equities got clobbered too. The fact that the bond market got clobbered, the fact that there was a lot less liquidity in the system than there is now, meant that the Fed had to back off the interest rate rise. And them backing off the interest rate rise really set off both the reality of inflation and the perception of inflation. And it took that, which is to say, it took 6 years from the point in time when the writing was on the wall about precious metals until the precious metals markets reacted themselves. Investors don't like to think in 6-year time frames. Investors have a very different time preference, and investors sadly believe that their preferences matter, which they don't. One of the interesting things that's happened to me, Aditya, is now that I'm in my 70s with less time on Earth, I've become more patient. It's sort of ironic that when I was in my 20s and 30s and I had lots of time left on the planet, that I was very impatient. I'm not patient because I have less time on Earth. I'm patient because I've lived through so many 5 or 6 year cycles now that I understand that that is the amount of time that's required for an investment thesis to begin to pay out.
For the second part of this discussion, I wanted to review the topic of whether mining companies are at historically low valuations relative to the price of the commodity, or whether the market is being efficient in terms of the valuations it is ascribing to these companies based on their business performance. I've selected a specific company to anchor this discussion. I would like to get your thoughts on this topic in the context of that company.
Warren Buffett would tell you that his fortune is proof of market inefficiency, that it would be impossible to outperform a market to the extent that he had if the market were efficient. So I certainly don't believe that, at least in the near or intermediate term, that markets are efficient. I forget who said it, but somebody said that in the near term, markets are voting machines. In the long term, they're weighing machines. And the market inefficiency is probably a time delta between the way people vote, which is almost always stupid, and how much things weigh. That makes absolute sense to me. So beginning, I guess, with the assumption that money is mostly made in markets on the delta between perceived value and actual value. Let's go into your charts.
The first thing I want to start off is this chart where I've highlighted the fact that in the third quarter of 2020 compared to the third quarter of 2023, when the price of gold was in that quarter was very similar to what it is today, the market was valuing this company at a 40% higher enterprise value. And this is one of the top 3 gold miners in the world. And the accounting value as measured by shareholder equity is very similar. And there were really 2 things that when I looked through the balance sheets, there were 2 things that really stood out. The first thing is that it is not the same business. If you look at the bottom line in terms of cash from operations or even free cash flow, you're looking at a somewhat inferior business than it was 3 years ago. And the second observation is that the multiples that the market is ascribing, whether it is to PNAV or whether it is to the earnings multiples like the price to cash flow, are also much lower.
Yes.
So we're seeing 2 things combine to create these low valuations today. And I guess the question comes back to my original question is the market efficient? What is the market missing, I guess, is my question.
One thing that the chart shows is that in 2020, the gold sector as a whole enjoyed higher stock valuations and higher enterprise valuations. I think the second thing that chart shows is deleveraging, which is to say that enterprise value classically is market capitalization plus total debt minus cash. And I suspect that the other thing that this chart shows is the deleveraging that occurred at the company in question. Their cash balances built up while their debt declined, so that enterprise value relative to shareholder equity would decline because of lower equity valuations, but also because the other side of the balance sheet shrank. I think that the point that you're trying to make, which is to say that at least the bigger participants of the precious metals sector are at historic valuation levels, is accurate. But I would caution you not to forget the second thing that I said, which is to say that the entire industry has been deleveraging. And I think that we're going to have to go back into a capital spending cycle in the sector in order to maintain production. I would also say that some of the PNAVs that we discuss probably need to be called into question unless you make more aggressive gold price assumptions. Because what has been happening is that inflation in the supply chain for production, but also inflation in the construction of new projects, has been outpacing everybody's estimations. And I suspect that unless you're fairly generous making gold price assumptions, that the PNAV assumptions that the investment bankers are making are somewhat aggressive. In the case of this business, the poor performance that you see exhibited on the chart, particularly with regards to net free cash, is being expressed in the anticipation of a continued deterioration of the business. I guess they are not getting credit for the recent uptick in both cash from operations and free cash from operations. I guess the next 2 years will tell whether the market is correctly looking at this or not. My own suspicion is that the senior gold sector is experiencing a record hiatus in interest that stems back a bit further to the incredible underperformance of the sector in the last gold bull market. I think that there's no anticipation of success in the gold mining industry, separate and apart from the gold price. If you take investors that were traditionally interested in gold prices, and if those investors remember, which some of them will, the performance of the gold industry in the period 2000 to 2010, where the gold price went from $250 something to, whatever it went to, $1,500 or $1,600. A six-fold increase in the gold price led to a decline in free cash flow per share among an amalgam of the senior mining producers. And my belief is that historic underperformance led many generalist investors to assume that the gold industry was going to continue to be a destroyer rather than a creator of capital. My own belief is different than that. My own belief is that those few remaining institutional investors now are employing much greater discipline on the companies that they invest in, and that the management teams that were responsible for that poor performance were in almost every case thanked and excused. So I think in that regard, the investment community has a misperception around the gold mining industry.
This is a question that came up when I was reading Berkshire's annual letters, and I meant to ask you this question a while ago, and I think it was in 1985. Buffett closed down the textile business,
right,
which was Berkshire Hathaway's original business. And the reason he closed it down was because he came to the conclusion that it was not a good business.
You're being very charitable. He came to the conclusion it was a horrific business.
They kept it going for 22 years.
Yes.
So, it was a long time, and you can kind of see the pain that he's going through every year in trying to justify it.
Yep.
But the question that came up, and I really wanted to ask you this question, is having been in the sector for so long and having the opportunity to see which businesses are inherently good businesses and which businesses are inherently bad businesses, have you ever been tempted to exit a particular commodity group?
No. When the perception of the outlook for a commodity is at its worst, the opportunity is at its greatest. These are capital-intensive cyclical businesses. Now, I am not one to tell you, Aditya, that on an apples-to-apples basis, the natural resource business is the best place to be in the world. It is, however, a place where I have durable competitive advantages over other participants. So for me, it's cyclicality, it's volatility, and it's capital-intensive sort of structure are suited to me. I believe, as an example, that the banking business, which I'm also in, and the insurance business, which I'm in, are inherently better businesses than extractive industries. However, because of my knowledge base in resources and because of my willingness to adopt a contrarian posture, I outcompete other investors in natural resources. It is true that I make all the money, or effectively all the money that I make in natural resources, in 2 or 3 periods out of 10. But given a flaw of my character, if I'm not early in an investment, I'm probably not going to get in. So I have to take that time value of money risk. So I guess I'm answering a few of your questions at once. Natural resource-based businesses are very suited to me. They may not be suited to other people who don't have good math skills, and for people who aren't suited to cyclicality and volatility.